So, so today we're going to do the discounted cash flow model for General Dynamics. And a discounted cash flow model is probably the best way to identify whether a stock is over or undervalued, because it uses the free cash flow, and that's really the lifeblood of any company, cash. When you look at earnings or you look at net income, that could be manipulated for various reasons. In time, the numbers will add up, but at any given year, numbers can be manipulated a little bit. But cash flow is the best way to look at a company. So let's get started. So let's get the market cap for this company. And we want to figure out how many shares the company has. So when we calculate our expected future value, we can divide it by the number of shares. So this company has a market cap of 39 billion and 290 million shares outstanding. Now let's get to the meat of the analysis. First, free cash flow. And we'll look at a cash flow statement in Yahoo Finance. It's all set up for us. And we need the last 4 years, so it's 1.8 billion, 3.4 billion, and everything's in thousands, so I have to add 3 zeros. So cash flow isn't always the smoothest looking number from year to year, because there could be a lot of changes. A company can invest a lot in something 1 year, like a building or an aircraft or something else that's expensive. And then they don't need to purchase that again for maybe another 10 years or maybe forever. So it's all lumped into that 1 year, that cash payment. But on the income statement, it's amortized or depreciated, so it's kind of smoothed out over, say, 10 or 20 years. So that's why free cash flow could be a little lumpy. But this company seems, it's in pretty good shape. Because sometimes I look at companies that have negative free cash flow, negative net income, and it's just all estimating what's going to happen in the future. But this looks like a healthy company. All right, and the net income has pretty much been growing each year. Revenue tends to be the smoothest number because there's really not much manipulation for revenue. Either you get it or you don't. And this company's revenue has been growing, which is a good sign if you wanted to invest in this company. So now that we have this, we still need to build out the capital structure so we can discount the free cash flow. So we need to figure out how much debt and equity the company has. So let's start with the debt. So interest expense, that's on the income statement. That's the interest the company paid on its debt, on the bonds. Now let's see how much debt this company has. So it's not listed in Yahoo. They just have okay, that was the assets. Let's look at the correct section, the liabilities. Current debt, that's debt due within 1 year. A lot of companies don't even pay the debt after when it's due. They just get new debt to pay the old debt. Kind of like a Ponzi scheme. New money paying the old money. And then the long-term debt, which is the debt that's due beyond 1 year, is 11 billion. So this company pays 3.8% interest on its debt, which looks correct. And income before tax, because we need to see how much their effective interest rate is, effective tax rate is. 4 billion. That's any income tax, because you have to discount the debt by the tax rate, 1 minus tax rate. So their tax rate is 17%. That looks right. Usually it's around 20% is the number that most people pay. So even though they pay 3.8% interest on the debt, you have to take that number and multiply it by 1 minus the effective tax rate. And that's actually the cost of the debt is 3.15%. And now we have to figure out the cost of the equity. And we use the capital asset pricing model to figure that out. And everything's all set up on my spreadsheet. I just have to enter the beta. That's a really good beta, 0.99. It's very stable. 1 is means that the company stock moves with the market. So it's pretty much moves with the market, this company stock. So the CAPM is 9.92%. And the market return is 10%. If it was 1, it would just be 10%. So that's the closest you get. So it's the least volatile I've ever seen. So the cost of equity is 9.92%. The cost of debt is 3.15%. And now we have to blend those together. So the company has 24% debt because it has 11 billion of debt and 76% equity since it has a $39 billion market cap. So we multiply the 24% by the cost of the debt, 3.15%, and we multiply the 76% by the CAPM, the 9.92%. We blend those together and it's 8.3% weighted average cost of capital, or the WACC. And that's how we discount the cash flows for this company. We use the WACC, because that's how much it costs this particular company to get money, 8.3%. And now it's all set up. So these are actuals, the actual free cash flow that we input. And now the estimation is based off of extrapolation of the net income, revenue, and free cash flow. This is for 4 years in a row, the free cash flow estimate. Then we do terminal value. Terminal value looks at the last year of free cash flow we estimated, and we multiply it by the our estimated perpetual growth rate. I put 2.5% to be conservative. That's the growth rate, but you could always change these numbers if you feel it should be more or less. And I'm using the Gordon growth model, or the dividend discount model. So I take the 3.1 billion, which is last year's free cash flow, times 1 plus 2.5%, which is right here in the formula, and I divide that by the difference between the required rate of return and the perpetual growth rate, which is the same calculation as you do when you do the Gordon growth model. And we have to discount or present value these cash flows, because this is after year 4, the $55 billion, the terminal value of the company. We have to discount it at the same discount rate as we did in year 4, which is 1 plus the required rate of return, which is 8.3%, raised to the fourth power. And it's the fourth power because this is the fourth year. And this is raised to the third power, second power, first power. So if you sum up these values, that's our estimation of what we think the company's worth in today's dollars, $49 billion. And we divide that by the shares outstanding, and we estimate the stock price is $170, and it's actually trading at $136. So it's trading at a 20% discount. So this is a buy. This based on the discounted cash flow model, we consider this a buy. And it's interesting to see, this is the last few years of the stock price. And you can see it kind of peaked above, a little above, like maybe like 230 it peaked. And it's been around 180, 170, which is just about what we calculated the stock price to be. So it was trading at its intrinsic value for a while, but then everything pretty much dropped. So now you have to make the decision, will this company be able to get through the pandemic? Does it need to take on a lot of new debt? Will revenue still be similar to prior years? That's what you have to look at now after we came up with this model and we proved the company's worth it. But who knows, anything can happen during these crazy times. But thanks for watching the video.